Secretary General, at the last meeting in Oman, OPEC member nations talked about extending the cooperation with non-OPEC member nations. Give us a sense of where discussions are.
Thank you very much for having me. You need to step back to December of 2016 when we entered into this accord with the non-OPEC, signing the Declaration of Cooperation that brought together for the first time 24 producing countries. As part of the Declaration of Cooperation, the decision also mandated us to work out a framework that would institutionalize this partnership beyond our short-term objective of rebalancing the market. So what was reiterated in Oman during the 7th Joint Ministerial Monitoring Committee some few days ago was the need now to begin to focus more on the mechanics and the elements of this framework in a consultative process that will eventually produce this institutionalized framework of producers and consumers, not limited to only the 24 producing countries, but still open to other producers. In November of last year, we had 30 producers who turned up in Vienna to show solidarity with the historic decisions that we took and the commitment in implementing those decisions faithfully throughout 2017.
Are you then saying that the cooperation will go into 2019?
The cooperation between OPEC and non-OPEC member countries within the umbrella of the Declaration of Cooperation will go beyond the rebalancing of the oil market. We want to institutionalize this partnership with the non-OPEC in the interest of not only producers but also consumers, in not only returning the market to balance, but to sustain it in a sustainable basis going forward.
So it is a yes then?
We are optimistic that all the participating countries will sign up to this institutionalization of our cooperation. We have not had one single member country who is thinking of opting out. We are looking at how we are going to frame it, going beyond the rebalancing of the market.
Do you have a detailed plan on how to exit the output cut?
Exit is not a lexicon in our vocabulary. It's I have just told you that we are looking beyond the rebalancing of the market. The market, in the fullness of time, sometime this year will return to balance. But the next step would be, how are we going to continue this cooperation, this partnership between OPEC and non-OPEC?
How about the cooperation between Saudi Arabia and Russia? How do you see that panning out and playing out into the oil market?
I think that bilateral cooperation breathes air or oxygen into the OPEC, non-OPEC cooperation. We have been discussing with the non-OPEC for several years, if not decades, on and off. But for the first time, you have seen two leading producers, both from the OPEC side and the non-OPEC side, leading the pack, leading the negotiations and the consultations in the run-up to the historic landmark decisions that we had in 2016, and also leading the pack in the implementation of the supply adjustments. In Oman, you have seen the two leading producers, Kingdom of Saudi Arabia and Russia, now co-chairing the Joint Ministerial Monitoring Committee. And these are very positive signals, not only for the group, but for the industry.
But there is concern in the market that the cooperation between Saudi Arabia and Russia will not be as long as they hope. Is the concern misplaced?
I think so, because we have confounded our critics several times, I think, in the last 18 months or so. First, They said it was impossible for OPEC as a group at that time to agree to return to its statutory role of managing supplies, which we had abandoned way back in the autumn of 2014, and contributing to the impact and the consequences of this cycle that we have seen, the worst in recent history. And we confounded them in Algiers after a marathon 7-hour meeting that was supposed to be an informal gathering of the IEF. We came out with an extraordinary conference, with an extraordinary decision, the Algiers Accord. And then they said, wait a minute, they won't implement it. And on November the 30th, we were able to come up with a blueprint on how to implement the accord, which was basically a range of 32.5 million to 33 million barrels a day, a range which was also innovative. And then they said, okay, wait a minute, the non-OPEC, particularly Russia, will not come on board. And on the 10th of December, the Russian Federation, Alexander Novak led 11 non-OPEC countries to join us in Vienna to reach this historic decision. And yet they said they won't implement it. Wait a minute. And from January to December of 2017, we have seen an unprecedented level of conformity to the supply adjustments by each participating country. On the average, we had a level of 107%. In fact, as a matter of fact, for December figures, which we just reviewed in Muscat in Oman, the conformity level was an outstanding 129%.
Do you expect that conformity level to be sustained?
I think we have demonstrated beyond any reasonable doubt our commitment to this partnership, because this partnership had not only turned a new page, and together with our non-OPEC friends, we believe that we are changing the landscape, if you like, for good. You have seen the market is responding. You have seen demand is growing. The global economy is responding.
Has the global oil market been rebalanced, or are you close to rebalancing the global oil market?
We are on course to rebalancing. Between January and December 2017, the first year of the implementation of the Declaration of Cooperation, we saw inventories above the 5-year average plummeting from a high of 340 million barrels to just about 118 million when we met last week in Muscat. And with the numbers being reported yesterday by the EIA, we are on course to hitting the 100 million mark. So there is no doubt that the market is on course to restoring balance that had eluded it for several years.
When do you see that happening, a balanced market?
Well, the past 2-3 years, the effort, the focus, the narrative was on working together to restore balance, to assist the market in rebalancing. This year, the narrative, we are changing to a balanced market.
We have oil hovering at $65 to $70 a barrel, a level which some say encourages shale production. Should you be worried, or are you worried?
For the first time in history, we, OPEC, reached out to the independent producers in the shale basins in the United States in order to break the ice, to begin to exchange views and compare notes, because we all belong to this industry. One of the key takeaways from that exploratory meeting was the common understanding that we all have a shared responsibility to the continuous stability of the oil markets, because we all belong to this industry. Now, going forward, we have revised our recent numbers for Shell or tight oil production in the United States. We are now hovering above 1 million for 2018, and we welcome these revisions, because without the numbers, without the barrels, the supplies of nearly 6 million barrels a day coming out of the shale basins in the U.S., the story would have been different today.
But any week now, it will reach 10 million barrels a day.
Well, in total.
The first time since 1990.
Yeah, you're talking.
What are the consequences of that?
Well, we have a very strong demand environment. What we are seeing is the industry is responding to demand growth that we have not seen in several years. And this demand growth is also based on very strong economic fundamentals. We have seen not only OPEC, but the IEA and other agencies continuously revising not only their demand numbers, but also GDP growth. I just came out of a session with Christine Lagarde. The IMF had revised their global growth numbers to 3.9%. We have not seen these numbers since before the global financial crisis. So we remain confident that this demand growth will continue not only in 2018 but 2019, and will accommodate these incremental barrels that we are seeing from the United States and the non-OPEC as a group.
People have talked about the threat of the electric car. Where are you on that?
Well, we as OPEC, we have been part and parcel of the global consensus on climate change. First of all of us, all our member countries are developing countries that are impacted heavily by the impacts of climate change. Before being OPEC members, we are poor developing countries. And therefore, we needed to join this consensus in order to protect the interests of developing countries, particularly ourselves, who are also dependent on this one commodity, which unfortunately is being focused upon not only as the challenge, but a possible solution. All our member countries, for your information, have signed up to the Paris Agreement. More than half have already ratified. Several of our member countries are investing heavily in diversification of our energy portfolio, energy mix. Countries like Kingdom of Saudi Arabia, Qatar, the United Arab Emirates, and several other countries are focused on diversifying sources of energy as well as sources of revenue. Electric cars, yes, is a reality, but look at the numbers. We were reminded yesterday by no other person than the IEA's Fatih Birol, who told us that 30 years ago, the ratio was 81% fossil fuels in the global energy basket. 30 years ago. Today, it's still 81%. Going forward, the world will continue to need oil and gas to meet the growing demand going forward. And he also reminded us that as of today, 1.1 billion people, mostly in our own part of the world, have no access to electricity. Today, we are reminded by the IMF, 2 billion people have no access to credit, all from our part of the world. Therefore, we remain confident that the world needs to continue to invest in our industry. We have over 1 trillion barrels proven reserves across regions that this world will continue to rely upon as a fuel of choice to fuel growth, not only now, but in the future.
Secretary General, thank you so much for your time today.
Thank you.